Okay, do your camera. Oh, no, the mic is what you, can you hear?
Hello,
Hello, happy Thursday.
thank you.
How's everyone doing?
We're good.
Ask if you open your camera.
Yeah.
Sometimes they don't want you to.
Feel free to turn on your cameras, guys.
Okay, hold on.
You don't have to, but you can.
Let's
I think I
see.
heard that
Okay,
question.
camera X
This
down.
is this me? Charles Ryder. Where am I? That's not me.
Down
Where's
there, you
my
have the camera X out. Look to the left.
left?
See the camera, more to the left, to the left, to the left. See that X?
Yeah.
Undo it. There you go.
Hello.
Hello. We're just going to wait a minute to let people join.
Yeah. Oh boy, got good reception.
Without fail, as soon as I start digging into the week's training, I got a whole bunch more people to join and I have to start again. So I'm going to wait just another minute or so. Hope everybody's having a good week so far. It's good. I see a bunch of new names. So if you're new to the Thursday trainings, hi, I'm Kendra Rhodes. And I will be, today we're going over, we're going to be going into the software. We had done a quick overview last week of exactly what you're putting into the software to build a plan for a client. And this year we're going to dig into the back end of that. Okay, great. You've built a plan. Now, how do you execute it? So we're going to go into the software and I will show you how to figure out what you're going to be contributing. And then we're going to go into our Forrester's illustration software and actually do the builds. So let me let a few more people in really quickly.
What was your last name again?
Rhodes.
Oh, Rhodes. Where's Rhodes? One more question.
Yes.
I'm new here, and it's my first time joining.
Welcome.
So I'm a little late to the party. So I would like to also start at the beginning after review. I'd like to get some directions for that. So I can.
Yeah. So there are a couple of different things that you can do. One, if you actually get a subscription to the software, the boot camps are all recorded in there. So it really goes into great depth from start to finish, what to say to a client, how to sit down with the client, what you're actually doing for the client. And it takes you through step by step.
Okay.
The software is also fairly self-explanatory. There are little info buttons on every single page. And it's almost like a flow chart that just drives you through step by step through the process. Also, I do these trainings every week. So, and I'm going to start doing a bit of a pattern so that one week we're digging into the software, another week we're digging into a particular product, and the other 2 weeks, sometimes 3 in a month, we'll dig into some financial concepts that will help you with various understandings and ways to communicate with a client on things that they may not know. So yes, so hang out with us. We're here every Thursday. With that, I think it is 4 past now, so we're going to get started. And if people come in late, all of these trainings are recorded, and I've just gotten some good news. Actually, we're working on a platform that will hopefully be executed in short order, such that with the software, you'll be able to log in and see all of the past recordings that you'll no longer need to email somebody to get them.
Okay, one last question. Where do I
Yep.
go to get the software?
So it's lifeplan360.com.
Yeah. got that. Okay.
And
Lifespan360.com.
life plan. So let me just copy this. I'll put it in the chat. So it's lifeplan360.com.
Very good.
Okay.
The video's not even showing anymore.
Which
I've
video?
On Life Plan 360, all of them. I cannot pick up anyone.
From where?
From off of the website.
Which video you're looking for?
Everyone that's on there from 20 to 21, none of them shows up.
Let me
So,
see something really quickly. They should be.
Just give me a
Um,
number. Just give me a number to call home office, and I can get it worked out.
So let me share my screen really quickly. So share screen 3. Okay. So can everybody see my screen?
Yes, I do.
Okay, great. So if you're in the software, you come down to training required videos, and all of the Life Plan 360 full video, the step 1, step 2, step 3, all of the videos that have been in here are still in here.
Okay.
Right, but they will not play for me.
They won't play for you.
Well, some of them say not available.
Huh, sorry, videos don't exist.
You see, that's what I get.
Interesting. Let me write that down real quick, and I will find out. It's been a while since I've watched them, so let me find out what's going on. LP 360 training videos do not exist in software. Okay. In which case that is still fine. So yeah, last week we did kind of an overview of the software, but I think where a bunch of people are new on here, I'm going to go ahead with the training as planned for today. But next week, I think I'm going to dive straight into the software and really start going through step by step. So all of the new people can see it. There's some really great features and really great tools in there. So with that, does anybody have any questions on that before I get started? Great. And I do try to mind the chat, which is right up view, admit all. But if you have put a question in the chat and I am clearly not answering it, I'm trying to do many things at the same time. So please feel free to unmute yourself and just participate. But otherwise, please keep yourselves on mute to mind the background noise unless you have a question. Or if you're answering my questions, feel free to jump in. Because I very much like class participation. So we're going to clients. So inside the software, anytime you put in a new client, it keeps track of that for you. Fun feature. So we're going with Peter client. This is a client that we put in some weeks ago for a training that is loosely based on real people, but the names have been changed to protect the innocent. So we're going to go to step 3 because we were talking about doing a build today. So I'm just gonna mute some people real quick because I have some background noise coming through. Admit. Okay, so guys, just please mind your back. Accidentally. Okay, there we go. So we're sorry, admitting people at the same time. Bear with me, please. This is what I was just saying, that as soon as I try to get going, everybody jumps in. So great. So this is a client that we built a few weeks ago. And so we've already sorted out what their monthly contribution is, what their annual contribution is. And is there a reason that we don't have? Yeah. So normally, and I'm going to show this two ways because I think it's important to know. So in this case, we're going to look at the pile of cash that they have because we've just built the bank. So for people who have not seen this before, the concept is private banking. So what we're trying to do is to build a bank for every family. So two things that a bank needs. One is cash, which is a big pile of money. The other is cash flow, which is basically income because, you know, if you don't have a big pile of money, you can't have money that goes out. And if you don't have income, that pile of money is going to deplete very quickly and you won't be able to do what you want with it. So they're both equally important. But when you're going through that with a client, and you ask that question, whichever one they say, agree with, they are right no matter what they say on that question. Okay. So we are going to, I'm going to pull up my illustration contribution calculator. So can everybody see my little spreadsheet that I just pulled up? Yes? Yes, no, maybe so?
Yes.
Okay,
yes.
great. So basically we're trying to protect somebody's whole life. So no matter what can possibly happen, they are protected. So this being a life insurance concept, we are trying to utilize life insurance to build a private banking system. So that being said, there is still a death benefit component to the bank, which is important because when you have a death benefit component to the bank, you know, should something happen that you're losing that person's income, you know, that family is still protected. And it's not just the big pile of money that we're creating for them. So that being said, we need to protect this family against that loss as well. So when we're putting a bank on both people, the husband and the wife, or both parties, whoever they happen to be, we want to take into account what their income is, because if that income was lost, we want to protect this family against losing their lifestyle. So person one is making $120,000 a year. Is that enough zeros? Great. And person two is making $50,000 a year. So their annual contribution is $170,000. Excuse me, their annual income is $170,000 a year. So their annual contribution, as we see over here, is really $67,000. $67,000. Okay. And their one-time contribution in this first example that we're going to do is 0. So we're going to leave that be. So we're going to come over here to the percentage of household income. So person one is making just over 70% of the household income, and person two is making just under 30% of our household income. So, and this little tool here that I've created does all the math for you. All you have to do is input some numbers. But the annual contribution is $67,000. So what that means to our, so guys, please mind your background noise. So what that means to our annual contribution is that of this $67,000 to be in the same ratio as our income is going to be $47,300 a year, and person two will be $19,700 a year. So, okay, what does that mean? Why do we care about this? So we're going to come over here to Foresters, because now that we know how much premium we're going to be putting into each one of the policies, we can come over to our illustrations app, and we come to Foresters Home, log in, click on illustrations, and it'll load in a second, and it brings us here. And whatever state they're in, you'd put that under jurisdiction, but just for kicks and giggles, we'll leave it as Colorado because it doesn't actually matter. You just can't show people an illustration that is not for their state. So I always make it a medical illustration. And for this, I will leave it as valued client. But we are going to, but if this was an actual client, I would put in their name. So we know that the first person is male, but if we come into our software, if I go to clients, I want to go to, we were in Peter client. So we want to see their profile because I want to know their dates of birth. So 7/4/1976. Oh, that's right. They were a bicentennial baby. 7/4/1976. Okay. So it would be important that we know whether or not our client smokes. But other than that, unless I already know that there's a condition, I run all illustrations as standard. So then we come over to death benefit and funding. So we're going to come to the case design dropdown. And because we're building a bank, we're going to come down to the fourth option, which is FPUA, permanent/term blend, non-MEC face solve. It's very important that it be non-MEC because we never want this to become a taxable event. So for term percentage, you can leave that as 75. Depending on the client's needs, you can run it as low as 50 or 60, as high as 80, 90 if you really have to achieve the client's goals. But keeping in mind that you are a financial practitioner, you are not doing this for charity, and the vast majority of your commission is based on the whole life percentage. So I usually keep this in the 70 to 75% range. So we'll leave that alone for right now. So for this illustration, because they don't have a single contribution, we're going to leave that at monthly, but that brings me over here. So 47, let me bring up a calculator. 47,300 divided by 12 is 39.50. Okay. And if you guys notice, I'm rounding up. 39.50. So for right now, we're going to leave the reduced paid up option as no. If a client really wants to see what it will look like, oh, I'm retiring at 65. If I want to stop contributions at that point, you just click this over to yes. And then at the beginning of whatever year it is they're planning on retiring, and you can show them that. But I never put that in their head if they do not ask, and here's why. Because if you put that in their head, they have this idea in their head that they have to stop contributing at that point. Well, maybe they decide to wait a couple of years for retirement, or maybe they decide to retire a couple of years early. They have it in their head now that at that point they stop making contributions, and it may alter the outcome. So I never put that in their head unless they ask. So then we come over to riders, and it will load eventually. Okay, perfect. So we're going to come down to term coverage, and I put a term 20 on most of the time. Reasons to not put on a 20-year term is if they are older, and the cost factor would start to deplete their cash value. Definitely take in the age of their kids. You want to make sure that their kids are grown before that is expiring. So there are reasons to use a 10-year term. I generally default to a 20-year term. Okay, so up here, I'm going to drop this down. So keep in mind that this is maximum annual payment. So we're going to drop this down to say 50,000. Because this is the max annually that they can put into the paid up additions rider. And the paid up additions rider is where the cash value lives. So that is where we want to keep that. So I believe this number here, because we put it on monthly premium, is a monthly contribution to the paid up additions rider. So that being said, at this point, we're going to take a look at the at a glance. Okay. So coming in here, we notice that at the 10-year point on the guaranteed side, they're putting in $47,400 a year, and at 10 years, they have a guaranteed $477,000 in guaranteed cash value. So when I say guaranteed cash value, what does that mean? That means that it does not include any dividends, meaning that that is the absolute bare minimum that they are going to get. So if we come over here at the total cash value, the likelihood that they're not going to end up with that total cash value is incredibly slim, because a company like Foresters has paid dividends every year for over 100 years. So World War I, World War II, the Great Depression, the crash of 29, the Korean War, the Vietnam War, the bicentennial, COVID, both Gulf Wars, the Challenger explosion. None of these things affected Foresters' ability to pay a dividend every single year. So there's no reason for us to expect that that wouldn't happen, but I can absolutely, beyond a shadow of a doubt, by contract guarantee this, which is why I point that out. But anecdotally, you can repeat to a client exactly what I just said. So yes, that being said, let's see what happens if this client tries to put in more money per year. Let's say they got a raise. So we have put in a monthly premium of, what did I say it was? It was, let me let people in. Sorry, bear with me a second. We're putting in a monthly premium of basically $4,000. So, and that annualized is $47,400, which is like $100 more than we had originally said in our spreadsheet. So does anybody know what a 7-pay premium is? Anybody?
You mean like a 7-pay paid up premium?
Nope.
7 years and you're done paying.
We're done. Yeah.
Not quite. So the 7-pay
IRS, right?
The guideline.
Yes, thank you, Keisha. This is for the IRS. So this is the max amount of premium that you can put in for a period of 7 years. So a policy has to be paid for a period of 7 years, whether it is coming out of their pocket or it's coming out of the cash value. For it to be a life insurance policy, it must be paid for 7 years. And during that 7 years, there must be a specific ratio set by the IRS between the death benefit and the cash value. So if you go over that ratio, it becomes a modified endowment contract. The IRS says, hey, wait a minute, that's an investment, not a life insurance policy, and the whole thing becomes taxable, which is not what we're trying to achieve. We're trying to achieve a tax-free environment for this bank. So that being said, we have to follow the 7-pay premium rules, which means that this number right here, the $47,400 a year, is the most amount of money that we can put into this policy based on the death benefit without it becoming a modified endowment contract. So there are a couple of ways to get around it becoming a modified endowment contract. So let's say that this client had, we're going to go in here. We're going to go back to step 3. Let's say they have another asset, and we're going to say that this asset is a mutual fund. It belongs to the client. It doesn't matter. They're not contributing to it, and it has a balance of, let's say, $70,000, just for kicks and giggles. Okay. Oh, by the way, if you don't put in the zeros, it won't let you continue. I fall prey to that all the time because I'm like, it's 0, but no, you actually have to put it in. So fun fact. Okay, so great. So now we have, where did my asset go? Oh, right here. So we're gonna add $70,000 to our life plan. And I've just completely made this up just to see, just for you guys to see how this would work. So what that does is we can now build space in the policy. So we're going to take this $70,000 and bring it into our little spreadsheet over here. Illustration contribution. So our one-time contribution is $70,000. Enter. Actually, we're going to make it $100,000. It just occurred to me that the math on that is not going to work out as I would like it to. So, $100,000 update. Great. So we're putting in $100,000 over here. Okay. And this right here tells us what our total one-time contribution is and how we're dividing that out. So I'll explain what that means in just a second. So let me bring that back over here. So remember, we're right now maxed out on our 7-pay contribution. So coming back to death benefit and funding, we're going to put this in as an annual payment because with that $100,000 bulk money up front, we can now afford to pay the full first year premium all at once. So bringing back our spreadsheet. So if we take this $100,000 and we divide it out by the ratios of their income, on person 1, we have approximately $70,000. And on person 2, we have just about $30,000. So remember our annual contribution limits. So 47.3 and 19.7. So we're going to subtract those from our one-time contribution. Because, and does anybody know the reason that we do this?
That's the maximum amount.
Close. So the reason that we subtract the annual premium from our one-time contribution is so that we now have the ability to pay annually, because Foresters has a fun little tool called the Premium Deposit Fund. And what that means is that to the client, it still feels like they are paying monthly. So they can contribute their $3,900 every month into their policy, but it actually fills up that bucket called the Premium Deposit Fund. And so they pay their first year premium on day 1. They pay $3,900 monthly. And then on the anniversary, they now have that $47,000 in the Premium Deposit Fund, and the policy will pull the $47,000 directly into the policy as an annual payment. The reason that we want to do this is because the insurance company has decided that there's less risk on a life that is paying annually. So the life insurance component is less expensive, which means that the cash value grows faster. Does that make sense to everybody? Yes. Okay.
Yes. Okay.
Okay, good. So that being said, so we said that our annual contribution was $47,300. So that being said, it really didn't change a whole lot, because if all we've done is change our payment from monthly to annually, our 7-pay premium is still $47,300. So if this person gets a raise or they have some extra money floating around, there's nothing they can do with it. They would need to start a brand new bank. But where did my spreadsheet go?
So I have a quick
Okay.
question for you.
Yes.
So basically what we're having them do is we're having them pay monthly, and the other money is just in that deposit account. So it's just pulling it. They're just paying a year in advance each time. Is that kind of where we're going with that.
Yes, so with their bulk money, the first thing that we do, because a lot of times, you know, if somebody's got $100, $200, $300,000, we're not going to be able to get that whole thing into a policy all in year one. That would push the death benefit up too high, and they may not be insurable for that amount of death benefit.
Yeah.
Also, you don't want them to have too much death benefit, because that death benefit costs money, which costs them cash value down the road. So you want to keep the threshold between their annual contribution and their maximum contribution realistic. So you don't want there to be a $50,000 gap.
Okay.
You know, if like $7,000 or $8,000, maybe they get an annual bonus every year. Maybe they get, you know, a tax refund every year. Maybe they're expecting, you know, inheritances aren't a great reason to do that, but you know, maybe they're expecting that they are going to get certain raises at certain intervals. You know, maybe they're a teacher or a fireman, policeman, that they know when they're going to get raises and how much. So you want to be able to build that in without them having to start the process of starting a bank and having to prove insurability all over again. So you build that space in. So let's say they have $100,000. We're subtracting out that first year contribution, which brings this $100,000 down to $33,000, which is a much more reasonable number to get into two policies in a short period of time. So we now have 70 minus 47 is $23,000. So we can divide this by 3, which gives us our $7,700 to put in. Or if they want a little bit more space, we could divide it by 2. You know, just basically what we're trying to do is build a little bit of space. And that tool is very helpful for people who are just starting out, so that they don't have to remember the math, they don't have to do the math. So the premium deposit fund, the maximum contribution to the premium deposit fund is 2 years of annual premium. So what that means is that if they're going to continue to pay in monthly, it has to be the maximum of year 1 plus year 2. So it's very important that we pull that first year premium out of what's going into the premium deposit fund, so that they have the space to pay in monthly, which most families will want to pay in monthly. So to put in a lump sum, what did I say it was, $7,800? Notice I use nice round numbers. There's a reason for that. 1, it makes for a prettier illustration. 2, I always round up, which creates a slightly larger amount of space. And you know, it's just easier to read. And you know, the difference between 77 and something and change and $7,800 a year, they're not even going to notice.
Let me ask you a question at this
Yep.
moment. Would it be possible maybe in the future, when you have to repeat this episode, that you insert also a condition of sudden death upon inside this process that you're explaining now about the 7-day pay premiums and stuff like that, where you don't want to accumulate too much to pay until the end of the year or something like that?
So what do you mean
does-
by a sudden death? When?
Well, the client is following the program, is fantastic. What would happen if he loses his life, if he dies?
Oh, I can tell you that now. So so right now we're building the space. We're going to the at a glance. I'll answer your question and then move on to what I was saying. So let's say pick a year. A number 1 through 10. 40
I'm sorry. I think yeah, 47.
Great. So you know, they've been paying the premium for what, 6 months, and then they have an accident, something happens, and they died.
Yes.
Okay, great. So once this policy is in place, their day 1 death benefit is $1.185 million.
Right.
So if they've paid 1 month of premium, their family is protected. So
Okay.
their beneficiaries would receive almost $1.2 million. Day one.
All right.
So that is where you as a financial practitioner comes in to assist the family in figuring out, okay, great. We don't have the income anymore. We have this bulk money. How do we deal with that so that our lifestyle doesn't collapse, but the family is protected? Does that make sense?
Yeah, that's what I wanted to hear.
Okay. And hence why a life insurance policy makes great sense to protect the family's whole life. Hence why it's Life Plan 360. It's a full circle on anything that can happen to them. You know, their kids go to college. They need to do some renovations on the house. They want to retire. Eventually all of us die. That's a fact. So it's not a matter of if, it's a matter of when. So their family is protected in that circumstance. You know, the roof leaks. None of us plan for emergencies to happen. They just happen when they feel like happening. It's Murphy's Law. You know, so you have the money inside the policy to assist in those emergencies. And you also have the death benefit to A, provide legacy, or B, you know, protect your family against the loss of a provider and that support. I'm just going to take a couple questions because I just realized that I've been neglecting the chat box. Can we get a copy of the slide deck? Is there a presentation provided that we can review? So Tim, this is not a slide deck. I'm actually doing this live. But yes, so we're working on a platform inside the software that will have all of the recordings of the weekly trainings that I do that will be available through the software. So definitely get the software so that you can access them on demand. What is the interest rate on the PDF? I'm not entirely sure what the by contract interest rate is. I can tell you that the guaranteed cash value column is guaranteed. I can tell you that the total cash value column is approximately 5.5% is the lowest dividend, the lowest payment dividend plus guaranteed rate that has been paid in the last 60 odd years. Yeah, 60 something years. When will the questions be answered through the chat screen? My apologies. I have been remiss at, I'm multitasking. I apologize. And what will happen to the money in the PDF? Joe, what do you mean by that? Joe? Oh, at death. So you're talking about the guaranteed cash value column? Okay, great. So when the death benefit is paid out, if you have a loan against the guaranteed cash value, let's just take year 10 for kicks and giggles. So let's say you have a $250,000 loan against this. So there would be $300 odd thousand, $250 odd $1,000 available to loan against. So basically how that works is the life insurance company is so willing to loan you money at an incredibly low interest rate because they're at a zero risk loan, because this is a whole life policy. So they are guaranteed to get their money back, because one thing, you know, the two things in life that are guaranteed are death and taxes. So death is inevitable. It's just a matter of when. So if they had to pay out this $250,000, $2.25 million death benefit, and you have a $250,000 outstanding loan, basically what happens is they take that $2.25 million, subtract the loan, they get their $250,000 back, your beneficiaries get the rest, which in this example is about $2 million.
They're reducing that number.
I'm sorry?
They're reducing that number from that death benefit.
Yes. Yes. So if there is an outstanding loan against the policy, they get their loan back. The beneficiaries get the rest. So the PDF should be paid to the insured plus the accrued interest at the time of death, along with the face amount of the policy minus any outstanding loans. The PDF should be paid to the insured. I don't have any control over that, but the way it works is that basically a life insurance policy is an asset. So the asset is the death benefit. The cash value is what the insurance company is willing to let you use against that asset. It's kind of, so think about it as a home equity loan, right? So the PDF.
It's a collateral. They're using like a collateral.
Yes, it's basically collateral. Sorry, I was trying to read things that were popping up in the chat. It's basically collateral. So you have a death benefit. You own the death benefit. But the life insurance company is willing to allow you to use that as an asset, just like you would leverage against a home for whatever it is that you need to leverage against your house for. So that house is the death benefit. That home equity is the cash value, is basically how I would say that. So that equity has value, but let's say that you sell the house, right? Are you going to get the equity plus the value of the house, or are you
No.
just going to get the value of the house?
Reducing that number, whatever the color.
Right. So, and when you sell the house, if you have a mortgage on it, you still have to pay the bank back and
Right.
you get the proceeds. So it's the same thing with the cash value and the death benefit. So the insurance company will pay you, or your beneficiaries anyway, they will pay the death benefit minus any loans against the cash value in the event of your death, which will happen eventually. It's just a matter of when. So which is a concept also that we as insurance agents and financial practitioners really need to become comfortable with, because I find myself doing it. I hate using the word death with a client, especially the words your death, but it's because all of a sudden the conversation becomes morbid and they realize their own mortality. But it is an eventuality. All of us will die. It's just a matter of how we control that conversation to make them feel comfortable with it. So, death and taxes are the only two things guaranteed in life. So it's not a matter of if, it's a matter of when, which, you, me, and the insurance company are all hoping that all of your clients live to be a very, very old age. Why? Anybody have any guesses?
Premium will be coming, more premium is coming because of that.
Because they make more money. They make more money. The client makes more money. It's a mutual love society. Everybody makes money because money grows money. So the more money that comes in, the longer that this money sits there, the more money the client makes, the more money the insurance company makes. So yes, they want your client to live a very long time. Okay, so that being said, we've gotten very off track of what we were trying to actually look at today. So looking at this here, in years 1, 2, and 3, we are putting in $55,100 per year per the contract. And then in the continuing years, we're paying $47,300. Basically, what this means is that we now have $8,000 of space in the policy in the subsequent years if this person got a raise or, for some reason got more money that they had lying around that they wanted to add to their bank. They can do that because they're not going to turn the policy into a modified endowment contract as long as they don't go over this $55,100. That being said, Foresters takes the average of the contributions into the PUA, the paid up additions rider, for years 1 through 5. So if we take a look at that, so $55,100 times 3 plus 47,300 plus 47,300, enter. That's $259,900. Now we're going to divide this by 5. $51,980. This is our new maximum for years 5 through 10. Does that make sense? Yes, no, maybe?
Got it.
Okay.
Is this for the PD? Is this for the PD?
The PUA.
PUA, I'm sorry.
PUA.
That's
So
the
this-
maximum they can put into their policy after year 5.
Yes. Yes, because of the PUA. So the premium is staying the same all the way down. So
Okay, so quick question. So it's gonna drop. So how you started the first 3 years at 55,100. The
Yep.
47,300 is always there, but that 50, that difference in between is the extra that they can put in to stay within the MEC.
yes. So if in years 4 and 5, if they want to put in $55,100, they can with nothing, no negative repercussions. They can't put in $55,101, but they can put $55,100.
Okay, so why did you drop it down on the, you get ready to tell us now?
In year 4,
Mm-hmm.
because we've officially run out of that lump sum.
Okay, gotcha. All right, gotcha.
So they have that lump sum, right? So that's how we're building space.
Okay.
So we're spreading it out over time
Mm-hmm.
to reduce the death benefit such that, maybe they wouldn't be insurable. Because what did we say their income was?
It was.
So 120.
Mm-hmm.
So
170.
$120,000 times 20. The general rule of thumb is that their max insurable rate is 20 times their annual salary. So in this case, we're nowhere close to that. But if they had like $500,000 from an inheritance or something,
Mhm.
it would be a problem trying to get it into a policy, even in 3 years. Never mind in 1. But yeah, so with some people, their income to lump sum ratio becomes a problem. But that's the general rule of thumb. But you want to create a little bit of space if that's something that's important to the client.
Okay.
Maybe it is, maybe it's not. I wrote a policy for a freelancer. And he was trying to keep his actual minimums pretty low. But when he has money, he has a lot of money. So he's like, well, what do I do with it? I want to be able to put it somewhere that it's growing, that it's safe, and will be there when I want it. So we built him some space.
Gotcha. Okay. Got it. I got it now. Thank you.
Yeah. So his was a little different because we built it such that he had space starting in year 2. He didn't have a huge lump sum, but he was looking for space. So we bumped up the year 1 premium a little bit more. And then, so the point is that the possibilities are endless on how to do a build. But for, the people who are just wrapping their head around around this concept, I wanted to keep this example as simple as possible, so that it made sense because for people who have been in the industry a long time, a lot of us are thinking that we're looking for $500,000 of death benefit and it's going to cost us this much. That's not what we're doing here. Notice that none of these numbers end in 0, not a single one of them. So the thing that ends in 0 is the contract premium. What we're trying to accomplish is cash value. So that being said, if we, because I just want to be mindful of time. So if we come down here, remember we had that 20-year term policy? That 20-year term rider rather. So at age 66 in year 20, he's got $3.1 million of death benefit. In year 21, that term rider falls off. He now has $2.4 million of death benefit. But that number keeps growing. But I mean, they've also got $1.2 million of usable cash value. So do you think this family is going to be upset that that term rider fell off here?
No.
Right. And this gap right here is another reason to keep the term percentage reasonable, because if you start with like a 90% term rider, there's going to be a big gap when that term rider falls off. So I usually shoot for between 65 and 72-ish%. You don't have to keep it on the fives. They are never going to know. Unless they do the math themselves, they are not going to know that it is 75% term and 25% whole life. But that paid up additions rider, what that does is with the dividends, it buys more permanent insurance, which is why the death benefit is ever increasing. So
I have a quick question on that. So
Yeah.
why do I see sometimes people online are doing the 90-10? Why would somebody do a 90-10 on that?
because it builds cash value very quickly.
Yeah, but then it affects how we are paid, correct? Gotcha.
It definitely affects how we are paid. It definitely affects the longevity of the policy. I mean, I was looking at, I have one client that I went to 85 for that I'm still working on this one. But it just so happens that they're not looking for longevity of death benefit. They're looking for a place to keep their cash value. They want to keep the cash value growing as quickly as possible. This person also happens to be very close to me, which is why I'm willing to do that. But I also know this person's needs very, very well. And they have plenty of death benefit elsewhere, but they don't have an ability to build a lot of cash value with the plans that they currently have. That is why I would personally do it, and in very rare circumstances. So in all of the clients I have, we've had this discussion twice. So, but yeah, it's something that you really have to know your client, because you want to know that you are protecting their whole life. I happen to know all of the other policies that this client has. And I was comfortable that as long as they are planning on keeping those other policies, there's no reason to have, $4 million of death benefit in 10 years.
Right. Okay.
So yeah, so that is the reasoning behind the 90-10 policy, but it looks really pretty upfront, but in the long term, you may be hurting your client and you're definitely hurting yourself now. So I do try to make sure that there is a reasonable ratio between whole life and term. But to just give a quick explanation of how this works and why we need that term, like you can't go 100% whole life. It will not build cash value nearly quickly enough for them to use it as a reasonable savings tool. Because what is the one thing that clients always tell us about whole life?
Cost of insurance?
I'm sorry?
Cost of insurance?
Cost of insurance. Thank you.
Thank you.
So whole life is, quote, very expensive. I use air quotes because I'm about to prove that it isn't. So term life is cheap. So let's say that you have a $500,000 30-year term policy and it has cost you $75,000. Okay. So at year 30 plus 1 month, what do you have? Anybody?
Say that one more time. I missed the end part of what you said.
So you have a $500,000 term, 30-year term policy that has cost you $75,000 over that 30 years.
Mhm.
At year 30 plus 1 month, what do you have?
Zero.
Zero.
No.
You've got nothing.
Right.
Okay.
Right.
How much did it cost you?
75,000.
75,000.
Exactly. So same $500,000 policy has cost you out of pocket $150,000, but this one is a whole life policy. Okay. So a whole life policy inherently builds cash value. It's slow, but it does. So at year 30 plus 1 month, what do you have?
500,000.
You have everything you paid into it at least.
What's
And
the
you
face of-
still have that death benefit, right?
Oh, yeah, that benefit. I'm sorry. Yeah.
So you still have the death benefit and you have all of the money that you paid into it available for your use. So how much did it cost you?
150,000.
Nothing.
Nothing.
It cost
Nothing,
you
you're-
nothing because you still have it and you can access the cash value inside of it. So between the term policy and the whole life policy, which one's more expensive?
Term.
Yeah.
Term.
The term is more expensive, but
Kendra,
90,
sorry
Yep.
not to break you off, but you used two numbers. You used 75,000 for the term and 150 for the whole life.
yes, I did.
But there you use the same death benefit. Is that where they come on? You use the same death benefit on both?
Yep.
Okay.
In this example, yes, I did because and I don't have the exact numbers in front of me, but I mean, I just use that as a benchmark because I can say that whole life is going to be out of pocket right now. Very well could be twice the cost depending on age, gender, health risks, a number of factors. But it doesn't matter what it costs you out of pocket. What matters is the bottom line.
It is there.
So that term life is going to expire. Less than 3% of people with term life policies ever get paid a death benefit because it expires before they die. So that whole life policy has intrinsic value because by insuring your whole life, eventually all of us die. It's a fact. So that insurance company has that full risk for your whole life. It's just a matter of when. It's not a matter of if. With term, it's a matter of if, which is why it's significantly less expensive. So that being said, we've now determined that the intrinsic cost of whole life is less, but the day-to-day cost of term is significantly less because it will eventually disappear. So that being said, we bring back our 7-pay premium because we cannot put more than this in and we want to raise our cash value. So how are we raising our cash value? By raising the death benefit. Normally I ask for class participation, but we're like almost at 1 o'clock and I want to get through this. So we have to raise the death benefit. What is the least expensive way to do that? By adding a term rider. So that term rider raises the death benefit for the full 7 years such that our cash value grows a whole lot faster and we don't have the cost that goes along with it eating away at the cash value. So we still have the protection that term rider provides for the period of time. And that is the reason that I go for the 20-year term. It is slightly more expensive, but it is still protecting your client longer. And by leaving it on for a longer time, it has more time to build up that paid up additions. So that's not such a big gap when it falls off. And, does a family that's making $200,000 a year really need more than 2.4 million? It would be more than 2.4 million. So this is one person actually. And I will get into my tool that shows how to do a family illustration in another training. But does a person who is making $120,000 a year need more than $2.4 million of death benefit once his kids are grown? Probably
No.
not.
No.
So,
I mean, that depends, but more than likely not. It depends
Yeah.
on if they have, other vision and legacy planning of choice that they want to, maybe charity event or family type of thing. But other than that, you're right.
most people don't. Most people don't. There are
Yes,
reasons
yes,
to
I
have
agree
more
with
than
you.
that, but that is the reasoning behind the build the way we do it. Does that
Comment
make
from
sense?
Howard?
Yes, hi.
Yeah, term life is essentially a bet that you're going to die early
Yep.
and that you will need the protection during a specific period of time, and you're willing to pay so much for that protection. But
Yep.
it is not a long-term financial, in terms of long-term financial sense, it doesn't make much sense. It's a short-term play only.
Right, which is why I made the analogy that I did between
Yeah.
even if whole life is twice the cost, which one's more expensive as an investment?
Yeah.
So
I'm sorry.
let me just say this and then I'll take your question. So as a unit, if our objective is to build cash value, that term rider satisfies the government regulations at minimal cost, allowing the cash value to build, protecting the family in terms of death benefit, and does still provide longevity, because even when the term falls off, we've built enough whole life death benefit to protect them in the case of anything, literally anything.
Yeah.
Robert, what was your question?
And my question is this, I have a case coming up. It's with my younger brother. He's in his late 50s.
Mhm.
And is it worth it to build a case with him? And then he asked me, do you have one of these yourselves? I'm a little older than he is. What type of case or what type of program could I write on myself? Because people are going to be asking that. Do you have one of these yourselves? I just briefly described it to him, and he thought, I would like to have one of those policies myself, he said.
How old are you, if you don't mind my
Uh,
asking?
68. He's 58. He'll be 58 in July next month. And his wife is 65. Not
So
65, but 55.
I'm going to be honest with you. I actually ran an illustration for somebody who happened to have been 68 a couple of days ago.
Okay.
And in terms of building a bank, it doesn't make financial sense at that age because the cost of insurance is so high
Mhm.
that that you're not building a whole lot of cash value. That being said, there are other ways to do it. At 58, I would run the illustrations, see how they come out. And at 58, my guess is he doesn't still have kids at home, does he?
No, it doesn't.
Yeah. So he doesn't need to protect his kids. Is he married?
Yes.
Okay. So he's just looking to protect his wife. He's protecting his retirement.
Yes.
So at that point, you're looking at retirement planning, not necessarily life insurance planning. So there are a whole bunch of other ways to do it, like annuities, etc. If it doesn't make financial sense to have to try and build a bank, which it might not. It depends on a bunch of factors that
But what do you
need to run the
tell?
illustrations.
Yes, I don't want to take too much time, but what do you tell a person who asks you that they may be impressed with it, even if it's a lot younger person, but do you have one of these yourself?
So me personally, what I tell them, I do have one. I personally do not believe in risk at all. I don't keep any money whatsoever in an account that has inherent risk. That being said, at your situation in life, what you can tell them is this, that this is a project that you have come across recently. And at your age, because of the cost of insurance, that it's not possible, or even, I don't know what your medical situation is, but you could even say that you're uninsurable if that is in fact the case, that you wish you had known about this when you were their age when it did make sense to do it.
An
Yeah.
alternative, though, is he
Yeah.
could, if he wants to have a bank, he would insure a relative.
Yep, that's true. If he, how old are his kids?
Yeah,
Well, his kids are, wow, his daughter is like in her 30s.
She is a
That's perfect.
perfect candidate for it.
Okay, and plus a daughter has a daughter. His daughter has a daughter.
So the daughter having a daughter would be a different program because if her daughter's in her 30s, that child is a minor.
Yes.
and
So
then you would have the daughter do a bank and insure you.
wait, say that
No,
again.
No,
I'm saying that the daughter, the
Mhm.
30-year-old,
Yeah.
Yeah.
she could start a bank and have her dad be the insured.
Being
And
insured.
That
30
wouldn't
years
make
down the line,
sense.
huh? Well,
That
no, it
wouldn't
makes
make
sense
sense.
because his,
no.
It wouldn't
No.
be a bank. It could be a life insurance policy, but I wouldn't design it to be a bank. I would design it to be a death benefit.
Okay, but how would they? But my brother was impressed because of the ability to be able to have a cash value, be able to use the cash after. I said after 3 or 4 years, you can't dip into it, but after then, it grows rather rapidly, and I said it's like a 1.5 million or what. I was just being general, death benefit, and
So you can actually borrow against it after 10 days.
after 10 days. Okay.
Yep. Yeah, you don't have to wait several years. It's not an IUL. I always use whole life. Again, IULs do have inherent risk because there is a cost of insurance. So if it is not designed properly, it can implode itself. The cash value can eat itself away. And also using it as a bank, if you have a couple of bad years and you are using it to loan against, it can start to eat itself again. So I personally, in terms of the banking concept, I do not use IUL.
All right. All right. So what would you recommend for when just do a whole life, but it will be what would be the death benefit? About $500,000, depending on the type of carrier we use. So you can still borrow
Off
against
the top of my head, I don't know what it would be. Again, it's not death benefit driven. It is cash value driven. So it is premium driven.
Mhm.
If you're trying to build a bank.
Right.
So, yep.
Could I have a question? What is
Yep.
the age, is best for this product, IUL?
I'm sorry, say that again.
The age of the insured, when we're selecting the insured, like what kind of age, span? Like you told me 30 is the best age.
Oh, it's
Up
not
to-
necessarily the best age. I mean, honestly, the best age I would say is probably 18, but 30 is at somebody in their 30s is probably my ideal client. Because at that point they are likely married, they own a house, they've got kids, they have they've had some time to build their career, they're making good money. They have real responsibility, they have reasons to protect their lifestyle. Somebody who's 25 is starting out in life and they don't necessarily have a need to, everybody has a need to protect their lifestyle, but in their head, if they don't believe that they have a need, it'll go.
Mhm.
So
Okay.
they need to want it. And yes, Jose, they can build the bank on their child. And actually that is a two-step thing because your brother can use it as your brother can use it as a bank while he's alive, and then his daughter, if she chooses, can continue to pay the premiums or have it be a reduced paid up policy, either way, and she then becomes the contingent owner and can use the bank during her lifetime.
Okay.
Yes.
And
But he owns property. I forgot to tell you, my brother owns property though too.
which is not necessarily relevant to building a bank unless he was planning on refinancing. But again, this is a conversation that if necessary, we can take offline. It is now 10 past, and I do like to respect people's time. Is there anything last minute before we adjourn for the day?
When we doing the policy for the children, because maybe our age is older or uninsurable, then can we become the owner of the policy?
I'm sorry, say that again. There's some background noise.
If I write a policy, just an example, if I write a policy for my child, not a child, actually a son or daughter, so can I become the owner of the policy?
Yes.
Okay, thank you.
Yes. So there are regulations. So if you have insurance, it's best to have twice the amount of insurance that you are trying to put on someone else. If you are uninsurable, that is something that would be necessary to put on the application. If the child is a minor, it is a requirement that the parents have double the amount of insurance that you are putting on the minor child, unless the parent is in fact uninsurable, which I have run into that scenario before. But yes, put it on the application. That being said, the parent can use it as a bank throughout their lifetime. The child inherits the policy, and eventually the death benefit would go to the next generation or the next beneficiary, whomever they list.
Okay, that's good.
So, okay.
One last comment, please.
Yep.
That regardless of who the owner is, the rate of the insurance policy is always based on the age and condition of the insured. So
Yes, that is true.
That's it. Thank you.
Yes. So again, like there are a number of questions that I can't actually answer for people without running active illustrations with the age, gender, and premium. So, okay. That being said, it is almost 1:15. Please feel free to reach out to me if anybody has any questions, needs help with a specific build. I'll put my email in the chat.
Thank you, Kendra. You did
Thank
very
you,
well.
Kendra.
So that is my email. Please feel free to reach out if you need some specific help with a build. Otherwise, I think next week we're gonna run down the software from top to bottom.
Kendra, put that email one more time. It's gone.
Okay.
I'm going to take a photo of that.
Okay, give me 1 second. Okay. Let's add next step. .com.
Oh,
Okay.
Thank you.
Yep, that's me.
Okay.
Yep. So next week we'll run down the software, and everybody have a great weekend. And I look forward to seeing you next week.
Next week. Thank you.
Okay.
Bye.
Bye.
Bye, guys.